Hi, good afternoon. My name's Torian, and I was a financial planner and just wanted to make this video to kind of help. I needed to do this for my process anyways, so just kind of my own financial planning. So I wanted to show you just some of the tools that I use. They're free, and in my opinion, they're actually a lot better than some of the more, I guess, professional tools I used to use at kind of the old firm that I used to work at. So this website's really good. It's called Portfolio Visualizer, and then it's slash Monte Carlo simulation, and you can run a simulated Monte Carlo. Essentially, how I use it is I want to be able to see how long my assets can last at a given amount that I'm taking out per month or per year or whatever the period is. Um, so this is a very good um, tool to kind of test your financial situation. If you're thinking that like, hey, I've got a chunk of money or I've got a nest egg, I want to see how much can I spend for my lifetime or for a certain period, or even helping determine I don't know how much I can spend in kind of a safe, reliable way. This tool can help out a lot with kind of doing that. So I'll kind of just walk through the tool. I'm not going to do tickers. I just find that it's kind of overkill. And then also with tickers, so portfolio type here on the first one. Not going to do tickers because it's just if there's not enough data, the tool can't work properly. So asset classes I've found to be a little bit better. Initial investment amount. So this is how much you currently have, right? So I'm going to put 1.25 um, in there. Cash flows, oops, cash flows, right? And this is cool because it has little things here that you can. I guess they're not working right now, but um, I want to no contributions or withdrawals, contribution fixed amount periodically. So you can also like if you're in the accumulation phase and you want to see accumulation and a Monte Carlo simulation for that. You can also do that. So I'm going to do withdrawal fixed amount periodically, right? Because, and I think that's how most people will do it. They generally have a dollar number per month that they know, like, as long as I have this, I can meet my essentials and probably have a little bit of money for fun stuff as well. Um, Let me also talk about this gives a Monte Carlo simulation is a tool that provides a means to test long-term expected portfolio growth and portfolio survival based on withdrawals. Testing whether a portfolio can sustain planned withdrawals required by retirement or by an endowment fund. The following simulation are supported. I like to use historical. It's just that's what's actually happened in the past. Um, Statistical is also or forecasted. Really any of these, I'll probably run it with all four of them just to make sure that every single method, um, my just because I generally am conservative in my planning, will work. But in a nutshell, Monte Carlo simulation is kind of um, a effort to or a tool that is used to show on probability basis and like it runs like hundreds if not thousands of different scenarios and like if this then if this then if this then right it keeps running those scenarios with your essentially your portfolio to show, really like kind of the probability that you will be okay, or not, or it'll show you that like it's very likely that your spending's too much and the portfolio is not going to be sustainable. So withdrawal frequency, I'm going to do monthly just because that's how I actually take money out. And I want to do $2,500 a month, right? As I talked about in the last video, that's kind of my general budget here. Inflation adjusted, I'm going to keep that as yes. And simulation period of years. So for myself, I'm 34. So I'm going to use a pretty significant amount. So I'm going to go to age 84. If I want to be really conservative, let's just do 84 for now. Actually, let's do that'd be 89. So I'm about to be 35, so that would be age 90 for myself. Tax treatment, we're going to say pre-tax returns. I am using pre-tax returns for myself for a very specific reason. Let me also preface, this is not financial advice. This is just general education about a tool. I'm going through a scenario to just show you generally like how the tool works. And you should, for your own situation, especially if you're unsure about how to use software like this, or are not open to like learning more about like how to use software like this, you should talk to a professional, ideally a professional that charges on an hourly basis, not by assets under management or by commission, because just generally a lot less conflict of interest. But you should talk to a professional for your own situation. Just have to preface that. Tax treatment, I'm going to use pre-tax returns for this scenario for a very specific reason, because I do not expect that I have tax loss harvesting going on in my accounts. My income is essentially nothing. So tax is not a very realistic concern for myself. Simulation model, I'm going to use the historical useful history. That's yeah, that's fine. Bootstrap model, we can do block of years. Bootstrap, I wish it, let's look that up because I'm not even entirely confident. Bootstrap model meaning, right? This is the great thing about AI and Google now is it is a responsive pop-up dialog box that appears with the current web page. Bootstrap model meaning in financial planning, right? So let's do that. Bootstrap modeling, gosh. The techniques of creating a yield curve by bootstrapping your business. Simulation with bootstrapping with several applicant quantitative finance, for example, to test the robustness of a trading strategy. These aren't really helping. So, you know what, we'll come back to that. I believe that bootstrapping model makes, especially if you do like a block of years, will make it more conservative. Uh, that's kind of bootstrap modeling in Monte Carlo simulation. The resampling technique estimates the sampling distribution of a statistic or model parameters when the true underlying population distribution is unknown or difficult to characterize. We need distributions of uncertainty to feed in. That's why we'll go to Bootstrap and all the way throughout. Maybe I'll make a video about that because maybe I should learn about that. But well, defaults to single year. I'm going to use that. Sequence of return risk. Now, this one I do know. Sequence of return risk is actually pretty important. So I'm just gonna talk a bit because this one I do know about quite a lot. I used to explain this to clients in retirement often. Let's say, can I just please just give me the PowerPoint, please? No, I don't I don't want that. We are off to a bit of a rough start. Okay. So let's do we're gonna do sequence of return risk. And like what is sequence of return risk? Um, so when you are working, right? When you're working, we'll say this is time, and you're working, you are accumulating, we'll say assets, right? Assets. You are accumulating. This is known as the contribution phase or the accumulation phase of kind of someone's general your earning years. When you're in the workforce, you're earning money, your assets are growing because you're saving, you're earning the money, you're putting it away in brokerage accounts or IRAs or 401ks or what have you, but generally your assets are growing. And then you get into let me see if I can do it like this, and then we'll make the line can we make it more like dotted? Yeah, there we go. So end of accumulation phase, you decide, all right, it's time, I'm going to retire. And now you are going into the distribution phase, right? And this is really distribution phase of your life, right? So one of three things will happen in this phase, right? So we're going to do we'll use purple. That's fine. Your assets will either go down, they will relatively stay the same, or they will increase, right? Those are the three things that can occur at the point of distribution. I guess those could occur in the accumulation phase as well. But now that we're in the distribution phase, organically, if you are using your assets to draw income off of, organically, this is going to occur, right? So sequence of return risk and why it's important, right? If we use, let me go here and let me go to S&P 500 average returns, right? So on average, like generally like the 10%, you may have heard this, like 8 to 10%, depending on who you ask, how conservative they are. But generally, 10% is a fairly agreed upon average return expectation for the S&P 500 based on, however many years of data. And it's quite significant. It's like 60, 70, 80 years of data that this number kind of arises from. However, what is important, S&P return year over year, right? So we want to go back to here, and this is great. Yeah, this is exactly the chart that we want to see. Sequence of return risk is specifically regarding here, and I'll also put here Dr. Wade Pfau. That's how you spell it. Dr. Wade Pfau. So this gentleman has a great, that's actually his, I'll go to his website because I do want to point him out. It's this guy here, and that book is very good. I know it looks a little bit cheesy, the book cover does, but it's actually like a very technical, great book. I believe he is a professor who either teaches at Princeton or graduated from Princeton, got his PhD from Princeton. Princeton's in my mind that connected to him for some reason, but really good. Some of the best in terms of like technical financial planning literature that I've really ever come across. And he does put it in a way that is very, I would say as a professional, very accessible. That might be different for a layperson, but this is oh, I was playing Path of Exile, so I still got that Hot Wheel script. So I gotta change that. All right. but yeah, the retirement planning guidebook, it's a great book. I would recommend it. It's definitely in my top three for financial planning books. Um, but all right. But sequence, anyways, Dr. Wade Pfau talks a lot about this, and it is really one of the core. Um, it's important to be aware of going into retirement. So, how does this all work together? We looked at the S&P 500 averages, right? And that was that 10% number. But it's important to understand the market does not go just it doesn't just get the average all the time. Like you can't rely on that. The stock market is going to, I'm going to get 10% every single year, year after year. Just it goes up and it goes down some years, but most years, generally, it's going to go up. Sequence of return risk is the risk that in the very early, right? So if this is year one of retirement, right? If this is year one of retirement and we know that the average is 10%, but the sequence in which the returns occur is very important when you're taking withdrawals from the portfolio. So the average may be 10%, but if you get a poor sequence, meaning you get negative years very early, right? And think about this. If we look at this point, right, at this point here, this, kind of, can we make that? There we go. At this point, it won't be transparent, but right here where my mouse is, like if you can see that, at that point, that is generally when a person has the most amount of assets, right? That at any point in their life, that's the most amount of assets that they've ever had. So when you experience a, let's say, 9% drop, that will be the most amount of money, or I shouldn't say that, but that 9% drop in the very beginning has a disproportionate effect versus had that 9% drop happened much later in your life, right? Because the assets don't have to last as long. There may not be as many assets. The 9% dollar figure, for example, let's say just 10%, we'll make it really easy. A 10% drop on a $1 million portfolio means that the portfolio is now depressed by $100,000, right? That's 10% of a million. But so that's $100,000 of assets. I don't want to say that are lost, but are currently in value is depressed. And on a $500,000 portfolio, let's say for this person, they've been withdrawing and taking out systematically, but now they're much older, right? So maybe they're 65 here, $1 million, they depress 100,000. But maybe they're like in their 80s here, and the portfolio is now at $500,000, and there's a 10% drop. Well, that 10% drop on 500 is only $50,000 in terms of depressed value, right? So the significance in actual dollars is greater, right? And that's like duh, Torian. It's like that, obviously. Why is that really important? Well, that's really important because you are on a fixed dollar amount that needs to come out of the portfolio, right? Like, so that money needs to come out and go to you, right? Let's see if I can draw, just make this a little fun here. That money needs to go to you, right? In your retirement. And to do that, right, you will need to sell more assets, right? Assuming you're in like stock or bonds, if the portfolio is depressed, the per stock is not worth as much, and you need cash for your retirement. Therefore, you will need to sell more stock to generate the same amount of cash that you need for your spending. And that has a compounding effect, right? Because each stock, although it hasn't lost value, when you sell it, now you have secured that loss because you don't have the stock really in the account anymore to potentially rebound. And sequence of return is if you get a couple of years in a row of it going down when you initially retire, that is very detrimental. And I used to talk to clients about 2000, 2001, 2002. This was one of the worst things that could have someone who retired in 1999, right? They had all this great growth, right? Their portfolio is rocking. And then they would have been it would have rapidly depleted their portfolio with withdrawals, plus the market going down 3 years in a row, which had only happened before in, at least on this chart, Great Depression, right? And then, so kind of when World War II was going on. But this is a really poor thing, or like 2008, right? People who retired in 2007 must have been really soiling their pants, as a polite way to say, when 2008 hit, because I mean, gosh, like let's say you had $1 million portfolio on stocks, right? And then you lose 40% of that, or you get depressed in value by 40%. So now your portfolio is only 600,000. That is pretty nerve-wracking. But if you didn't sell, if you held on and believed in kind of the powers of the capital markets, you're eventually like very handsomely rewarded, made that back up. But anyways, sequence of return risk is definitely something I include. I do 2 years, worst 2 years first. So of all the simulations the Monte Carlo is going to kind of spit out, it's going to put the worst 2 years at the very beginning. So it has a more, it's just, it could happen. It could happen. It's from a probability-based standpoint, very unlikely. But I mean, here we have 2 years in a row. This is 3 years in a row. Here's, it's not probable, and you can kind of just see that by looking at the chart, but it could happen. And I want to make sure that if that happens, my withdrawal rate is kind of safe, right? We'll use historical inflation. That's fine. Rebalancing. I'm going to put no rebalancing because I personally don't do that. Not that my portfolio needs a lot of reason to do that. Intervals. That's fine. All right. So I'm going to put what kind of my portfolio looks like. It's almost exclusively. I'll just put U.S. stock market. It's almost exclusively stock, and then I keep about 5%, call it 6%, technically. All right, let's get that real exact, as cash. And so we're going to run the simulation. That's working here. All right, we've got our simulation here. And then now we get our results. So portfolio end balance in the 10th percentile, which I'm not super worried about, right? Would be zero. So it would have failed, essentially. Portfolio balance real, like, so this is the difference between this is looking at over that, basically in the end year, how much would the portfolio be worth? 25th percentile, right? In the top 90th percentile, right? Top 10%, top 25, 50% confidence, and then 75. Or the worst, kind of the worst 25th and the worst 10 there. So let's kind of look at it here. It might be easier on a chart. So this is saying, and like these numbers are they're so extreme. So portfolio survival, portfolio success, right? The odds of my portfolio living to that long are 71.59%. Um, that kind of breaks it all down, right? And here are the frequencies in which I end up with um, certain amounts of money in terms of the end balance here. These are going to be more going to talk about correlations, right? Expected annual returns, annual probabilities, loss probabilities. So a lot, I mean, the main things that I'm looking at are the performance summary, just to be honest with you. But if you're a real, I mean, I feel like I'm a nerd with this stuff, but if you're a real nerd, you can get into all the data down here. But this is the main thing that I kind of want to look at. So 25th percentile, right? In real terms. Um, but just look at, I mean, gosh, it's just such a you'll either have zero money or you'll have 61 million. You either have zero money, and if you get in the top 25% of the simulations ran, you'll have 273 million. And it's just such a wild, strange distributions, right? Like they're so extreme. Um, Here is maximum drawdowns, safe withdrawal rate 2.3. So that's the 10th percent. There is a paper on this that it kind of talks about this in terms of realistically, a 90th percent or a 90% confidence rating, which is what the 10th percentile is like not realistic to like how human beings behave. If the scenario was going this bad, I would probably take steps to do something like reduce my spending, or get a remote job or do some maybe just I do something, right? If it was going as poorly as like the scenarios here, generally human beings will do something or change their behavior. You have to understand the computer can only look at this from you take out this much inflation adjusted every single month, and that's what you do. Unfortunately, it's not quite as complex as like, well, if I made certain changes in either spending behavior or began having additional income and such, how would that change things? Um, so this is something I'm kind of okay with. Now, I do a little bit of teaching, right? So my withdrawal rate's not really 2,500. It's closer to um it's closer to, let's call it let's just say 2,000, right? And we'll see how that makes a difference, assuming I keep the asset classes, everything else the same, right? So by reducing it to 2,000, and as I kind of talked about in the last video, generally I'm not spending $2,500 a month over here. I spend about $2,000 a month. By year, what would I do? 55 years, right? Yeah. So by the time I'm 90, in real dollar, or excuse me, in nominal dollar terms, I'd have 20 million, and then that would be about 2.3 million in spending power today. Um, at 90. And it's like it's hard to, and so that's the inflation adjusted, right? So if prices were exactly the same as they are today, but at 90, you had $2 million and prices are all exactly the same. Even health, like it's hard to imagine what I would need 2.3 million, $2.4 million for at that age. Um, but I guess besides the point. Um, And that's something that I'm comfortable with, right? Like, so we've got the worst 2 years. Now let's see how big sequence of return risk plays a role. So I'm going to change it from worst two to one, and then I'm going to make the withdrawal rate kind of the same here at 2,500 a month, right? And now we'll run the simulation. Okay. So very significant, right? So it's very significant. Um, it's incredible how big of an effect that can have, and like let's say we didn't include sequence of return risk, which I say is a little risky, but just to kind of like show, now that's succeeding with 11 million, right? Where it was zero before. When you if you don't have a sequence of return risk occur in the first year, which it does not look like it's going to happen for myself because I'm close to end of the first year of me kind of being over here. So that's good. Um, but it just what an astronomical difference the sequence of return, those initial periods up front can make. And now at that spending rate, right? And also the spending is adjusted for inflation. That's going to be the draw free inflation adjustment, right? So that's here. We have yes, right? We do want that. Um, it's it feels good. It feels good to be able to see this. I feel like 94% survived all withdrawals. 94% of it's running 10,000 different scenarios. 94% survived the withdrawals. And yeah, it's just really good. Like we do inflation adjusted, that helps make it a log, right? Um, it's good to see. I don't know. It's good. Gosh, it's good to see that. It gives certain confidence to kind of doing what I'm doing. Now, if we made this really like realistic to my current situation, right? We do want to include, I do want to at least the first year, right? And made this closer to that because actually what it is, right? We're still in the positive, and then if we included like, okay, I'm continuing to do teaching in the very minimal capacity that I'm doing. Even right now, I make about $600 a month doing that. That's money I'm not taking out of the portfolio, so that 2,000 really becomes that. It's very probable, right? 97.8. And some people, that 2% is always looming for them. For myself, I'm kind of the opinion if it's greater than 60, and the benefit that I get in terms of not having to be in an office wearing a suit, doing in an office with no windows, and not being able to like take the best care of myself and feeling stressed all the time versus being able to come over here and live my life uh fairly comfortably. I would argue a higher standard of living. There's gives and takes with things, but generally very comfortable lifestyle. Um, I would take that, and to get it, have it at 97 and just say, okay, well, what if you lost your job and what if you're spending more or inflation, right? Um, do that. 86%. So it's still above what I would consider. Maybe like I'd be a little more like 75, but yeah, still it's 10% higher, 11% higher than that. I don't pay attention to this. I think this is a scare tactic that most advisors will use, like that unless this like it's so improbable. It's so improbable that I think it really robs people of enjoying the assets that they've worked so hard to accumulate. As long as these ones look good, that's kind of all I need. But anyways, this is the this is portfoliovisualizer.com, the Monte Carlo simulation. I'll put a link in the description, but I did want to just kind of go through that, show you guys how that works because it's really an excellent tool to be able to use for your own financial planning. I hope that helps. Bye.